Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Elizabeth Kashner, Director of Global Fund Analytics at FactSet Research. We're talking about the top stories of 2022 and 2023 outlook for the ETF industry. Elizabeth, welcome back. Nice to have you on the podcast again.
Happy New Year, Nina. Thank you so much for inviting me.
Yes, Happy New Year to you as well. So let's start with the inflows. So 2022 was a brutal year for investors, but it was another great year for the fast-growing ETF industry. And US listed ETFs attracted net inflows of almost $600 billion during the year, which was the second highest on record despite this continued market turbulence. And mutual funds, on the other hand, lost assets at a record pace, and which resulted in this about 1.5 trillion gap in the flow of money from mutual funds into ETFs. That is according to Bloomberg data. So tell us about your thoughts on ETF inflows. Was there anything that surprised you? And I was also interested in your forecast for ETF asset growth in 2023.
Wow, Nina, where to begin? There's just so much to talk about here. Like you, I think it's quite extraordinary that in a year where you would expect investors to be reactively pulling risky asset investments off the market, that we saw exactly as you said, the second strongest flows ever for ETFs. I think it's a real testament to the strength and desirability of the ETF wrapper and to the ability of ETF investors to take a bit of a longer view. So congratulations on that. From an asset class level, one of the things I noticed is that over the past 3 years, the flows into fixed income ETFs have been really consistent, right around $200 billion. We might talk a little bit later about some of the details of what the bond ETF investors were looking for. I think that's really notable. And then even on the equity front, we certainly see a lot of variability year to year in the overall dollar level that goes into equity ETFs. But this was the second highest year ever. And so, when the market does stabilize and eventually turn, as these things do, you can only really expect, I think, more tailwinds for ETF contributions. And then there's the last piece of the thing that really did surprise me this year. And that was the big uptake in interest in the leveraged and the inversed funds, the so-called geared products. For the full calendar year, geared funds captured more than 5% of the total flows. And we've never seen a number like that. Most years it's no higher than 2%. It's an average of 1.2% between 2016 and 2021. To see that level of interest in the riskiest of risky products in the ETF space, I did find that a bit shocking and just really expressing hope that the investors who are using these products have done a lot of homework and a lot of reading and understands exactly what their properties are, because they're tough to use.
Yeah, some inflows into leverage products, as you mentioned, the riskiest of the riskiest products. That surprised me as well. For example, the triple leveraged QQQ ETF, TQQQ, had taken in more than $12 billion last year, even though it was down about 80%. And the triple leverage semiconductor ETF, which is by direction, SOXL, that took in $6.2 billion, even though it was down 87% in 2022. So that was insane. You mentioned bond ETFs. Yes, we saw some very impressive inflows into fixed income ETFs. And in fact, we saw that many investors were dumping the beaten down bond mutual funds to harvest tax losses, and they were buying fixed income ETFs. And it is because we know that it is because of the way mutual funds are structured. They are forced to pass on capital gains to investors, and investors are forced to pay taxes on those capital gains, even if the fund is in deep losses. So ETFs are favored by investors because they are more tax efficient, they are generally lower cost, and they are easier to trade. Now, I wanted to talk about actively managed ETFs. So we saw that many actively managed ETFs were able to beat their benchmarks in these very challenging market conditions. And they also gathered a lot of cash because investors tend to chase performance. So these included the one by JP Morgan Equity Income ETF, JEPI, and one surprising winner was DBI Managed Futures Strategy ETF, DBMF. These gathered $12.8 billion and $970 million respectively last year. So do you think 2022 was the year of actively managed ETFs? I was interested in your thoughts on this rise of actively managed ETFs last year.
So I do think it's a fascinating area. It's worth talking about for a little while. It wasn't that long ago that actively managed ETFs made up 1% of all of the ETF assets. And I think, back in 2016, rounding to the nearest percent, active accounted for 0% of ETF inflows. And, the vanilla funds took in almost 80% that year. By 2022, we really see a different story where investor interest in actively managed funds took a real uptick between 2018 and 2021. And this is the year, I think, that it really broke out. The percentages that I'm about to give, by the way, are excluding mutual fund conversion dollars because those are not exactly new money coming into the strategy. They're simply money ported over from one wrapper to another. So even when you take out the conversion dollars, we saw 14% of the overall flows go into active and just 56% into vanilla. So that is a real change. And, Nina, I think you're right that overall, this was a year where many actively managed ETFs really did fulfill their potential to protect and to outperform your broad-based cap-weighted ETFs and market indexes. That's been unusual historically. Historically, active management has underperformed its expense ratio or higher. And I think, the jury is still out. We'll wait for our friends at SPIVA to run their analysis of the full calendar year 2022 across all of the active management universe. But certainly the funds you named, plus plenty of others, really did deliver on their promise. I think the other thing that's worth noting is that, we've had in the past couple of years some really significant mutual fund players enter into the ETF space. I'm talking about Dimensional and the Capital Group and a couple of years prior, American Century. And some of those have amassed a really loyal set of constituents who are delighted to be able to access the strategies that they know and love in a cheaper and more tax efficient wrapper. So, I think some of these dollars that are coming in are from investors who are new to the ETF space or newer to the ETF space. And, there's a case to be made that overall 2022 flows would be lower if these new users hadn't been introduced to the space.
Right. So you alluded to mutual fund to ETF conversions, and you also mentioned dimensional. So let's talk about them. So we know that mutual fund managers are converting some of their mutual funds into ETFs. They're also launching some of the clones of their popular mutual funds as ETFs. So Guinness Atkinson had started this trend of conversion in March 2021. And this was followed by a big move by DFA, Dimensional Fund Advisors. And since then, total about 40 mutual funds have been converted into ETFs. And recently, JP Morgan announced that they would be converting 3 of their actively managed ETFs with a combined 1.7 billion in assets into ETFs. So do you think this trend of conversion from mutual funds to ETFs will accelerate this year in 2023?
I think there's reason to believe that this trend will continue, but there's also reason to believe that it might taper off. So the reason to think that it will continue is that the actively managed mutual fund continues to bleed assets. You quoted some pretty impressive statistics for calendar year 2022. It's not the first year by any means where we've seen actively managed mutual funds losing ground. This year, we've definitely seen a blow to their asset level because of what's happened in the capital markets. But organic growth has been flat or negative for many, many, many active managers for a long time. And I do believe that they now see an opportunity to convert into the ETF space, whether it's into a non-transparent structure or the normal daily transparency structure that we see. It may be for many kind of the last best hope, but there's also reason to think that maybe not. And that reason is that conversion is not a panacea for curing the flows problem. I took a look at the flows excluding the converted dollars for 2022. And across the 19 funds that converted this year, we're just seeing a total of about $150 million of additional inflows. And when you average that out across all the funds, it's just about $8 million per fund. And we had just about as many funds with outflows post-conversion as we did with inflows. And so, for those who think that all they need to do is move into the ETF wrapper and their products will be reinvigorated, evidence is showing that that is really not the case. It takes something more, and in many cases may be a change in structure and not necessarily a change in the appeal of their products. So the jury's still out. I guess we'll see what happens.
So now I want to talk about fee wars in the ETF industry. And I saw an excellent piece that you wrote last year. It is called Cheapest ETFs Make Bear Markets a Bit Less Painful. It's available on FactSet website. So could you elaborate a little bit on the fee compression trends that you saw in the ETF industry?
So yes, Nina, of all of the things that were mixed up and unstable in 2022, fee compression, not one of them. We're seeing a really steady march across the industry, across asset classes, across strategy types to ever lower fees. This comes, as you're talking about, in part because of the fee war where asset managers directly cut fees on their products. It also comes out of investor preference as investors continue to really push their dollars into cheaper strategies. So on an asset-weighted basis in 2022, the average ETF cost about 17.5 basis points to hold. Looking back not that far, just to the end of 2017, that number was 23 basis points. So we've seen a swing of 5.5 basis points just over the past 6 years. Round that up, and it's a basis point a year that's being shaved off of fees. And some strategies are dropping much more quickly than others. And I think the one that is the most notable is right back at you, that question of actively managed mutual funds. They cost approximately half of what they cost at the end of 2019. So in the equity space, the asset-weighted average expense ratio for actively managed ETFs is 38 basis points. That's down from 49 last year. And in fixed income, it's also 38 basis points, down from 43 last year. So I think it is pretty clear that in the areas where competition is picking up the most quickly, we are also seeing many new entrants come in at lower price points and with real awareness of what their competitors are offering. And the smart ones are pricing well from the outset. Others may have to learn from experience and adjust their pricing going forward.
Very interesting trends from 23 basis points to 17.5 basis points in 6 years. And investors are the biggest winners in this fee war. So really good for them. So let's talk about ETF launches now. And 2022 was another impressive year for ETF launches. About 430 new ETFs were introduced last year, which is lower than the record-breaking number of 477 in 2021, but still very impressive considering the market conditions. And new launches included some very interesting strategies like single securities ETFs, single stock and single bond ETFs, night shares ETFs. So tell us about your favorite new ETFs which were launched last year.
Great question. You know, I really prefer to look at the launches from the point of view of the competitive landscape and how are they figuring out how they fit in an already very crowded landscape. And so when I think about it that way, you know, to me, from a consumer point of view, the best thing that can happen is that new funds can be launched that will increase competition in the space. And so I think I have two favorites of what came out this year. And they may surprise you because they weren't really big or splashy launches. But Schwab, for example, introduced a broad-based municipal bond ETF. I think that brings the number of plain vanilla muni bond providers up to 4 now, excluding a taxable muni fund. So your ordinary tax exempt muni funds, I think there's now 4 competitors in the broad-based vanilla space. And that's great because it's going to bring costs down for all investors. I also think that we've seen an interesting line of ETFs from a relatively new company called Bond Blocks. Their mission has been to introduce very targeted tools so that an investor who knows approximately what duration they want exposure to can get that on a consistent basis and not have some of the duration and maturity float that any market cap, any broad-based market cap fund will be exposed to. And I think to their credit, they've done it at very low price points, many of them 10 basis points or lower. These tools are for investors who know exactly what they want to do. And if you have a bit of a vague conception, you might find them intimidating. I don't think they're for everybody, but I do think that they did a good job of bringing, you know, reasonable targeted exposure in at a nice low price point.
Both very interesting strategies, interesting picks as well. Now, some alternative strategies, particularly managed future ETF, like we discussed earlier, like DPMF, and some other hedge fund like strategies did very well last year. Some commodity ETFs did very well, particularly in the first half of the year, when thanks mainly to the unfortunate Ukraine war. And I think investors realize the value of adding alternatives in their portfolio, commodities or hedge fund like strategies. Adding these strategies provides diversification in a portfolio. So, do you think alternatives should be a part of a core portfolio?
I remain very skeptical about the utility of alternatives in a core portfolio. I certainly don't take issue with you of picking out a couple of funds that have been extraordinarily successful this year. But I would point out that, there are, for example, 37 ETFs. Well, there were, a few of them have closed, that offer exposure to an absolute returns type of strategy. And, on average, these funds lost about 4.3% per year. Now, compared to equities or the bond market, obviously, I'd much rather have lost 4.5% than I would have lost 12 or 19.5. But when you think about what the premise of these funds is, that they will provide, positive returns over the risk-free rate over the course of time, it's hard to say that they're really delivering on that promise. In many cases, they are delivering a lot more volatility and a lot more market sensitivity than you would imagine. So it would be hard for me to advise that an unsophisticated investor add these to a portfolio.
Right. These are not simple strategies. Some of these are very complicated strategies. And we always tell investors that you should know what you are investing in. So if you are only comfortable with that kind of complexities, and maybe start with a small allocation. And yes, they did well. Some of these strategies did very well last year, but it was mainly because 2022 was a very unusual year. So it remains to be seen whether these strategies can continue to do well in 2023. So yes, all fair points made by you. Now, I wanted to talk about ESG. We have to discuss ESG whenever we talk about the ETF industry trends, because last year, these strategies face some real challenges. And we know that ESG ETFs are generally overexposed to technology and growth stocks, and they are underexposed to traditional energy stocks. So when technology did well for the past decade or so, these ETFs did very well, gathered a lot of assets. But last 2 years, energy has been the best performing sector. So these ETFs did not do well. The inflows were almost flat in these strategies. Some ESG ETFs had to liquidate as well. And we saw some anti-ESG ETFs launched, particularly by the firm called Strive. So according to Strive, large asset managers, they push divisive social and political agendas, and that causes companies to underperform and harm investors' interests. And they want to use investors' money for promoting excellence over ESG strategies. Companies should just focus on profits. So tell us about your thoughts on ESG strategies and the case for anti-ESG ETFs.
So I really appreciate all of the statistics that you were able to provide about what's going on in the ETF space. And I will add to that if you look at inflows in proportion to market cap and what you would expect at, given the starting market share, ESG dramatically underperformed this year in the equity space, missing out on some $6.7 billion of flows that their market share would have suggested that they get. But it's not that surprising. As you pointed out, the average return was poor. It was down 19.2%, worse than your broad-based vanilla equity indexes. And so I think investors who were expecting ESG to deliver risk protection have been very disappointed this year. I think ESG for a long time had marketed itself as a market return with a below market risk. The statistics had never borne that out, but for a while, I think some of the messaging got ahead with that. So this has really kind of been the year where that has come home to roost. But I do want to offer hope for investors who do want to tie non-financial values to a financial service product. And that is to look at what is going on in the realm of proxy voting. Now, I certainly understand that there are tremendous value differences and also tremendous differences in perspective in terms of risk assessment and an idea of what factors are and are not material to overall corporate success. But the most powerful place where investors can actually express their opinion on social issues, on environmental issues, and on how to roll that all up into a material concern is actually not on the trading floor, but instead in the proxy vote. Because that is where questions of corporate governance and management come up for discussion and debate. And we've seen a lot of activity into both positive and negative in terms of how the largest asset managers are and or are not voting their shares. We just saw Vanguard retreat from the Net Zero Alliance, not certain that their process was really aligned with exactly the same process at the alliance level. We've also seen a lot of discussion about the fate of BlackRock, where we have at the state level some activity removing investment from BlackRock management because of perceptions regarding BlackRock's attitude towards energy and climate. There's at least one ETF that I think would behoove clients to really pay attention to, in that it has made some very explicit promises about how they're going to be voting their shares. It's not a huge fund. It's engine number one. The ticker is VOTE, VOTE. It's a very sort of mainline, large and mid cap ETF that provides broad-based cap-weighted exposure, but they're very deliberate in terms of how they vote their shares. And I think this is the first product that we've seen that returns the economic power of the proxy vote to the ETF fund holder. So it's additional investor empowerment, which I think is always for the good. Do I imagine that we would see similar investor empowerment with different directions for proxy voting as various opinions play out in the marketplace? Yes, that's entirely possible. But I think the theory that one can influence corporate behavior by way of what one does and doesn't buy on the trading floor and place in the portfolio, that's always been a little bit overblown. And so, I think this is the year of a reality test in many ways.
I agree with you. And I do like the VOTE ETF for investors who are interested in influencing corporate behavior and using their investment dollars for promoting ESG strategies. This ETF is definitely worth a look. Ultra cheap with just 5 basis points expense ratio, and you get an exposure very similar to the S&P 500 index. And I also agree with you that we will see a lot of developments in the proxy voting area. Now let's talk about ETFs that you're watching this year, or your favorite ETFs for this year.
Well, thanks, Nina. I think I'm going to be watching the bellwether ETFs, which are the ones that have really the highest AUM and deliver very broad-based cap-weighted exposure, because these are the ones that investors use as building blocks when they're building out a core portfolio. And to me, that's an indication of increased confidence in the marketplace and willingness to stick to an agenda, right? So, we see a fund like VTI, Vanguard Total Stock Market Index Fund, did extraordinarily well in terms of flows this past year, not just on a raw dollar amount, but, also just on a relative basis to some of the other products that are out there. Even more so, I'd say the Vanguard S&P 500 ETF, which is real sort of stalwart of people who are strategic investors, not tactical. They'll just keep putting money in month after month or quarter after quarter. And, VOO, just by its market share alone, if all flows were proportional, you would have expected it to take in about $22 billion. But this past year, it took in just shy of $40 billion, which, to me really goes to show you that those very steady investors are still there. I will be interested to see who else returns if and when markets stabilize and then perhaps start rising again, if we'll see a return to those real core products or if we'll see more of a thematic or a returns chasing kind of approach. So yeah, for me, I'll be watching the S&P 500 funds. I'll be watching the core Vanguard suite. I'll be watching the core iShares suite to just see what people are doing at the center of their portfolios. And then, of course, we'll see what floats to the top.
Right. Very, very impressive inflows into VOO and VTI. VOO gathered almost $40 billion last year, and VTI gathered close to $26 billion in 2022. And that showed that long-term focused investors continued to pour money into these ultra-cheap plain vanilla ETFs that should be an important part of any core portfolio. That's all we have time for today, Elizabeth. Always a pleasure to have you on the show, and thanks as always for sharing your insights.
Nina, it's been such fun to talk with you. I really appreciate the chance to reach your audience and to catch up with you again. Thank you so much for the opportunity. Be well.
So that was Elizabeth Kashner of FactSet. Let's quickly summarize the tickers that she mentioned. So she's watching VOO, which is the Vanguard S&P 500 ETF. It charges just 3 basis points and tracks the S&P 500 index, as the name suggests. She's also watching VTI, which is the Vanguard Total Stock Market ETF. This also has an ultra-low expense ratio of just 3 basis points and provides exposure to the entire investable US stock market, mega caps to micro caps. She also mentioned VOTE, which is by engine number 1. It is the engine number 1 Transform 500 ETF, and this charges an expense ratio of 5 basis points. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast, and also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.